Hey everybody, what's going on? Charlie here. So we have a very important filing to talk about. It just got approved today, actually. I brought this up a few days ago. It's the ICC wind down and recovery plan that was proposed a few days ago. It has been approved as of today. Let's go ahead and take a look at what this is all about. So this is the first time ICC has filed with the SEC since becoming a covered clearing agency. And what that is, it's a agency that has been designated as systematically important to the overall financial structure, and they're also involved with higher risk activities such as security-based swaps, and they act as a central counterparty service, as in they provide risk management for hedge funds and banks. They're like the central point of those two involving security-based swaps. So if we go to the next slide here, this is basically the anatomy of a swap. So you can see step one would be to replace $1 million investment. The fund enters into a swap agreement with a bank. So instead of depositing the whole $1 million, they can put up 20% as collateral, and then they segregate the rest into their portfolio. Now, if the security rises in value, let's go ahead and say if GameStop or AMC rises in value, then the bank sends money to the collateral manager, being the ICC, and then the ICC sends that to the fund. Step four, if the security falls in value, the bank is paid and the fund posts more collateral to get back the initial 20% that we saw over here. And then the fund investors get returns for good or bad as if the fund had owned the security directly, even though they never did. So you can see how this can get everyone involved into a lot of trouble. This is what we saw similar in 2008 in The Big Short. Now look at the members of the ICC. A lot of big bank names here, including Credit Suisse, JP Morgan, Morgan Stanley, and many, many others. Bank of America, Barclays, Citibank, you name it. So the recovery plan is to restore ICC to a stable and sustainable condition in the event that it comes under severe stress. And number two, maintain effective arrangements for ensuring that losses that threaten ICC's viability as a going concern are allocated. Now the filing is broken into 14 parts, and I do like to keep my videos short, so I've just kind of picked out the important topics that are relevant, and I'll leave the rest in the description so you guys can take a look. So section 6 explains the interconnection between ICC and ICE. I already know that there's going to be a lot of people that don't watch this video who come out screaming that this has nothing to do with anything because ICC is not ICE. Well, yeah, they are. And ICE is the NYSE because they operate the NYSE group, which is a compilation of 5 exchanges, and the NYSE is one of them. Now, this is one of the most interesting sections, section 8. It talks about stress scenario recovery tools. And on the screen here, we see that auctions to close out a dealer's portfolio is one. Insurance policy covering specified losses resulting from a counterparty default. And a counterparty would be, for the ICC, it would be the hedge funds or the bank. And also a partial tear-up of remaining positions where ICC terminates positions of non-defaulting counterparties that exactly offset those in the defaulter's remaining portfolios. So in essence, what does this all mean? This is pretty much creditors on steroids taking over members' accounts when they're defaulted in the midst of a major financial event. Now, what major financial event could we be expecting? The MOAS. If you like this format, let me know down below. If you hated it, I'll go back to the old methodology. I figured this would be a little bit better way to explain things, but that is pretty much the essence of it. Huge stuff here, definitely relevant. So hope you guys have a good night, and y'all have a good one.